Hello, it's Simon Zutshi here, and in this video, I'm going to talk about inflation, I'm going to talk about raising interest rates and the impact that that has on you and your property investing. Now, this is really important to understand because your thoughts and beliefs around these two issues could impact the way you invest. Now, I've been investing in property since 1995. I'm the author of Property Magic, the Amazon #1 property bestseller. I'm the founder of the Property Investors Network, which is the largest network for property investors in the UK. And I've been teaching people like you for almost 2 decades how to become more successful investors. And I can tell you that the concern about rising interest rates is always something in the back of most people's minds they worry about. So let's talk about interest rates. But first of all, I want to talk about inflation. So what is inflation? Well, inflation is the cost of living. It's a consumer price index which is worked out by the Office of National Statistics. They look at about 700 products. They look at 18,000 prices for those products throughout the industry to work out this basket of goods, how much it costs. And right now, at time of recording this, inflation in the UK is a whopping 7%. Now that's a very high rate given what we've had over the last few years. And it's happened because the central bank, the Bank of England, has released a lot of extra money. The government has borrowed money because of the pandemic, and they put money into the NHS. They spent money on furlough schemes. They've done the bounce back loans. All this money is poured into the economy. With more money in the economy, it basically devalues. So the cost of goods have gone up. And so with an inflation rate of 7%, and the Bank of England believe it's going to get to 10% by the end of 2022, most people are feeling the pinch of that and feeling the cost. I mean, if you've been to the supermarket, you've seen how much basic commodities have gone up in price. Fuel has jumped up mainly because of the Ukraine war. We've seen because of supply chain issues caused during COVID, material costs have gone up, especially building materials. And also rents. I speak to a lot of letting agents, and the feeling is over the last 12 months or so, rents have gone up as much as 20% in some areas. So I believe the cost of living has actually gone up far more than 7%, but 7% is the official figure based on this basket of 700 goods. So what does that mean? Well, for the average person, we have less money in our pocket to spend. For the average person, inflation is not a good thing. However, for property investors, it's actually very good. And I explain why later in this video. But next I want to talk about interest rates. Now, we have had historically low interest rates for almost a decade after the credit crunch in 2008, 2009. We had Bank of England rates at 0.5%. And a lot of people, particularly investors who bought properties before the credit crunch, they now have mortgages that are linked to the Bank of England base rate. So it might be base rate plus 1 or 2%. So that means many property investors for a decade have had very low interest on their mortgage, and they've been making good cash flow on their property. Now that can only go one way. Interest rates have to naturally go up because 0.5% is not a sustainable rate. What that means is many investors, as interest rates have started to creep up, and as we film this today, the Bank of England have recently voted unanimously to put up interest rates another 0.25% up to 1%. There were some people on the committee of 9, 3 of them wanted to put it up 0.5%, but the majority went for a 0.25% increase. So what that means, every property investor who's got property, the cost of their mortgage, unless they've got a fixed mortgage, has probably gone up, so they're going to be getting less cash flow. Now there's a scenario I want you to be aware of. You see, as interest rates go up, landlords who've been very used to that extra cash flow are going to see that decrease over time as rates go up. You've also got people who own property in their own name, which always was the best way of doing it. Then Section 24 came in April 2017. Now I've talked about Section 24, hopefully if you're an investor you're very familiar with it. It means that if you own property in your own name, which many people did, and you've got mortgages, which most people do, and you're a higher rate taxpayer, which many investors are, it means you're going to pay a lot more tax on your property. So imagine this scenario. You could have the situation where if interest rates keep going up, you're going to have some landlords who've got properties where they're not actually making any cash flow because the increase in interest has eaten into their cash flow. And yet, on paper, they're making a profit because the way they calculate profit has changed. So they're not making any money, but on paper they're making a profit. That means they're going to have to pay tax. So they're going to have to dip into their pocket to take out money to pay the tax man each year. What do you think those landlords are going to want to do with those properties? Especially those people who've had them for the last decade or so. They've had really good capital growth. I think it's just another reason why we're going to see more and more landlords looking to sell up over the next few years. So actually, I think there's a real opportunity for those of us who are getting into the market or who want to build our portfolios to pick up properties from landlords that we can use in a different way, a more profitable way, and we can make it work where maybe those existing landlords can no longer make that property viable. So there's a huge opportunity from that point. Now, if you're worried about interest rates coming up, and I personally can't see rates going up massively, and the reason is this. The Bank of England historically have used interest rates as a macroeconomic tool to control inflation. So when inflation goes up, the Bank of England normally raises interest rates to make things more expensive to cool down the economy. And it works really, really well. The problem this time, although inflation is at 7% and the Bank of England base rate is only 1%, and you would expect it to be higher, the Bank of England is under a bit of pressure from the government because the government's borrowed so much money during COVID. I mean, billions and billions of pounds. The national debt has massively increased and the government has to pay the interest on that national debt. And if the Bank of England base rate goes up, it means that they're going to pay more and more interest, which means that they could get to the point where they can't afford to meet those interest payments because it's such a big debt. So the Bank of England can't afford that. So I think that's why the rates have not gone up as much as we might expect them to go up. I think they will continue to rise, but only marginally. Now, if you're worried about interest rates going up, what you could do is you could decide to fix your mortgages. Now, in the UK, as an investor, typically we get a buy-to-let mortgage that's an interest only. What that means is we pay interest every single month, but the capital is still outstanding. And I'm going to talk about that later on because it's very important when we think about inflation. Now, you can either have a variable interest rate where you pay depending on the Bank of England base rate, or you could do a fixed mortgage. Now, I can't give you financial advice, but what I can tell you is on the properties that I'm buying right now, because by the way, when you know how to find great deals, there are some great opportunities even if there's a booming market. So I'm buying property right now. I'm also remortgaging some of my property and I'm putting them in 5-year fixed interest rate mortgages. So in other words, for the next 5 years, I know exactly how much I'm going to pay no matter what happens to the interest rate. Now, if you fix your rate, you do pay a slightly higher rate than a variable rate, but I'm just hedging in case interest rates go up. I want to make sure I can easily afford to pay the mortgage and still have a really good cash flow on my property. Then 5 years later, I'll probably remortgage that property. So, interest rates is a big challenge for property investors, but what you could do is refinance if you want to secure the rate. Now, in some countries like America, you can fix your rate for up to 30 years. And if we could do that, I probably would, but in the UK, it's typically 5 years at the moment. Now, let's talk about inflation, because earlier on I said that inflation can actually be a good thing for property investors. Most people, most homeowners, it's not good, but for us, it's good for a few simple reasons. First of all, the value of our properties go up thanks to inflation. So we're going to get better capital growth when we have higher inflation. Also, the rents, because cost of living goes up, rents go up, so we're going to get more rental income. And that's a little bit of a way to offset increasing interest rates if the rents are also going up as well. But the third reason is the most significant one that I wanted to explain to you, and I want to make sure you really get this. You see, inflation is our friend if we have debt. And as investors, we borrow money secured on a property to fund that investment. So we typically get a 75% loan to value mortgage, and we might put 25% deposit in, typically our money or ideally someone else's money. So a £200,000 property we're buying today, we'd get a £150,000 mortgage and put £50,000 in of our own money. Now, over time, if we had an interest-only mortgage, we pay the interest every month, but we still owe that £150,000. And if we had a 20-year mortgage, in 20 years' time, we'd still owe £150,000. But the higher we have inflation, what it means is the true value of that mortgage, that £150,000, is eroded with inflation. So the higher the inflation, the less spending power that £150,000 has, such that in 20 years' time, when prices have all gone up and the value of our property has gone up and probably doubled twice in that time period, because in the UK, historically, if you look over a 50, 60-year period, on average, property prices double every 10 years. Now, I'm not saying that all prices double every 10 years. That is an average around the country. It kind of depends when you bought, what you bought, where you bought, but that is very much an average, which absolutely holds true. So the property you bought for $200,000 in 20 years' time might have doubled to 400 and doubled again to 800,000. And yet your mortgage is only 150,000. So if you sold that property worth 800,000 in 20 years' time, you'd have to pay some tax. You'd pay capital gains tax unless it was your own home, which at the moment is exempt from capital gains tax. So you pay some tax, but after paying the tax, you'd still have enough to pay off the mortgage and have plenty of money left over. Now, that money you could use to pay off some other mortgages. And my actual investing strategy, when I first started, I wanted to buy 10 properties at an average value of about £100,000 at the time. So I thought I was going to get £1 million of property. And my thought was, as property goes up in value over time, once it's doubled in value to £2 million, I would sell half of the properties, 5 properties, pay off all of the mortgages and have £1 million of property completely unencumbered. That was my plan, my strategy. Now, obviously it's changed over time, but the thought was to sell some of the properties to clear all the debt. So as long as you have a few properties, you could sell, or realistically, you'll probably refinance some of those. You see, your own home where you live, your residence, well, you've got to pay the mortgage off probably by 65 or 70, because the mortgage company's going to say, well, when you're retired, how on earth are you going to afford to pay your mortgage? But your investment properties, you don't really have to pay them off. You see, you're not the person who's paying the mortgage every month. Your tenants who are renting the property from you cover the mortgage, the insurance, the maintenance, the management, and hopefully have some profit left over for you. So they're covering the cost of your asset that is going up over time. So in 20 years' time, you could just remortgage that and hold on to it. I've got clients who are 70 and they're getting 20-year mortgages. You know, the mortgage might last longer than they do. Let's hope they live that long, obviously, but lenders have a very different view to an investment property than one that you live in as well. So this is why inflation is actually good for us as property investors. The only one downside is the potential risk of having higher interest rates, but we can mitigate that risk by obviously fixing our interest rate. So I hope this has been useful to help you understand that actually interest rates and inflation may not be as bad as you might thought they were if you read the press. Be very careful reading the press. You want to listen to people about property who actually understand and have property. We've got a lot of free training on this YouTube channel. I have my Property Magic podcast, which comes out every Tuesday. It's a short 15 to 20 minute podcast. There's no interviews, no guests, just me sharing my thoughts on property, some hints and tips. You might want to check it out. In fact, there's probably going to be a link below this video so you can come and check out the free Property Magic podcast every single week. I do hope you've enjoyed this video. If you have, please like it. Please hit the bell icon so you subscribe and get notified when videos come out, and make sure you are a subscriber, because I have a new video or two every single week that's really going to help you to become a more successful investor. I've got another video lined up for you. I hope it's going to be useful for you. So I encourage you to invest with knowledge, invest with skill. See you in the next video. I do hope you got massive value from watching this YouTube video. I'd encourage you to click on the link below to come and do the online training with me. And I've got another video lined up for you, which I think is also going to be really useful, that you should watch once you've registered for the online training with me. So invest with knowledge, invest with skill. I'll see you very soon.